Double-digit sales growth can ignite excitement, but it doesn't always translate into richer rewards for shareholders. Jollibee Foods Corporation, once a champion of Philippine fast food, is now a global contender, accelerating its reach far beyond home. Overseas sales are surging at twice the rate of the domestic business, a signal that the vision of Chairman Tony Tan Caktiong is being realized in numbers. Yet beneath this momentum lies an uncomfortable truth. The payoff to shareholders isn't keeping pace. At first glance, the top line glows. First half revenue reached 162.45 billion pesos, with system-wide sales climbing 12.4%. International revenue led the charge, rising 14.5%, more than double the 6.8% growth in the home market. It's a textbook case of transformation in action. More brands, more markets, more customers served around the world. But success measured in margins tells a different story. Net income fell nearly 17%, and profits attributable to the parent declined 13%. Direct costs are climbing faster than revenues, with inventory, store, and manufacturing expenses outpacing the gains in sales. Gross profit inched up, but gross margins slipped to 17.6%, operating margins narrowed, and net margins are now just 3%. The pain is sharpest in food service, the engine that powers company-owned and supplied restaurants. Despite higher sales, segment profits sank 39%. In contrast, franchising stood resilient, posting profit growth as asset-light models delivered steady returns. The lesson is clear: scaling company-owned operations globally absorbs more resources, and not every market or brand returns value at the same pace. Consider coffee bean and tea leaf, an essential pillar in the international portfolio. Sales hit 12 billion pesos, but net losses deepened, erasing expectations of quick profitability at scale. Other international ventures present a mixed bag. Vietnam's Superfoods Group is thriving, while South Korea's Compose Coffee and new acquisition Shobu all day contributed, but failed to lift overall Korea profits. Amid these global ambitions, the Philippine core must carry ever more weight. For decades, it has been the bedrock, funding acquisitions, expansion, and dividends. Now, the returns from overseas bets remain uneven, while financing costs and debt service rise sharply. Interest expense has grown, and joint venture results have swung into the red, adding further pressure below the operating line. For shareholders, this means a familiar dividend with little inflation, even as international ambitions soak up capital. The promise is growth, the near-term reality, a modest payout. Investors are being asked to trust that today's transitional pains will yield tomorrow's global strength. Yet there are green shoots. The second quarter flipped the trend. Revenue up 10.7%, operating profits edging higher, and net income rebounding. Margins improved from the first quarter's lows. This suggests the worst pressures may be temporary, as new brands and markets bed in. Jollibee's international journey is far from finished. It's proved its capacity to build and buy, but not yet to turn every new venture into a profit engine. Until returns overseas match the financial power of its resilient Philippine and franchise businesses, growth will continue to look impressive, while real rewards for shareholders remain a promise just beyond reach.